Hi, my name is Ravi. Welcome to my channel, Payment Talks. Welcome back to the Payment Talks ISO 20022 Payment Lifecycle Series. This is video 3, FI to FI payments and cover versus advice. In the first two videos, every payment started with a customer. Northwind Traders sent money and we followed it all the way to a supplier. But what happens when the payer isn't a customer at all? What happens when the payer is itself a bank? By the end of this video, you will know exactly what changes when both ends of a payment are banks, why two methods called cover and advise are secretly built from the same pattern, and one hidden relationship between two banks that quietly decides three separate outcomes across this entire series. Quick recap for anyone joining mid-series. Every flow uses the same seven actors: a debtor and creditor, their two agent banks, two correspondent banks connecting them, and a payment market infrastructure sitting quietly underneath to settle the funds. In video 1, we walked the straight through happy path using Payno 1, Paxo 8, Paxo 2, and CAMT 54 or 53. In video 2, we covered what happens when that path breaks. A rejection produces either a status message or a return, never both. And a payment already in flight can be cancelled two different ways. Today, that changes. What happens when the payer itself is a bank? The FI to FI canvas starts as a variant of the same seven lifelines you already know. Change 1. The debtor and the creditor stop being a customer and a supplier and become banks instead. That's the defining feature of this whole video. Every single actor in the chain is now a financial institution. Change 2. The GPA tracker disappears from the canvas. Not because tracking stops existing. It runs under a separate optional service called GFIT, GPA for Financial Institutional Transfers. Same underlying idea as the tracker, just not mandated for this type of payment, so we won't repeat it here. Change 3. Sender correspondent and receiver correspondent get renamed to intermediary 1 and intermediary 2. Those correspondent names only make sense when debtor agent originates the very first bank to bank leg, the way it does in a customer payment. Here, the debtor is itself an FI and initiates the transfer directly. There's simply no initial sender role left for debtor agent to fill. Changes 4 and 5 happen together. Long intermediary chains are rare in FI to FI payments in practice, so we drop them for focus. What's left is the final working canvas for the rest of this video. Debtor, debtor agent, PMI, creditor agent, creditor. Five actors, one clean line. One more piece before we walk the flow. The message running through this entire video is Paxo 9, Financial Institution Credit Transfer, not Paxo 8. Paxo 8 is used when either debtor or creditor is a customer or corporate, a non-financial entity. Pax 9 is used precisely because the debtor and creditor both sides are banks itself. There are two ways this canvas actually settles a payment. Scenario 1. Direct accounting relationship, no PMI involved at all. Steps 1 and 2, Pax 9 and Pax 2 move between debtor and debtor agent, just like the start of any flow. Steps 3 and 4 are where it gets interesting. Debtor agent and creditor agent settle straight through their own Nostro and or Vostro relationship. Pax 9 and Pax 2 pass directly between them. No PMI, no correspondent chain, nothing in between. Now, the crucial question: who physically holds the settlement currency account? If creditor agent holds the creditor's account, the books are already updated. So it just sends a credit notification information of the credit as step 5A. Creditor agent might send a real-time notification CAMT54, or it can also send this credit information in statements CAMT53 or 52. But if the creditor itself holds its own account for that currency, Creditor agent is only a chain connector. The funds movement at creditor needs to be via the payment message only. Creditor agent has to forward the actual PAX 9 as step 5B, and the creditor acknowledges with PAX 2 step 6B. These are alternate endings. Only one of them happens on any given payment. Either notification messages if settlement completes at creditor agent, or the actual payments itself if the settlement has to be completed at creditor. Scenario 2. Steps 1 and 2, PAX 9 and PAX 2, move between debtor and debtor agent, just like the start of any flow. This time, the PAX 9 hops through the PMI, steps debtor agent to PMI to creditor agent. Here's the one detail worth locking in. The PAX 2 acknowledgement step 4 comes back from the PMI itself, not from creditor agent. And this is settlement confirmation that is happening at the clearing or RTGS rail, not the payment status acknowledgement that happens at the bilateral bank level. One more thing at the PMI hop. When a payments amount exceeds a scheme agreed clearing threshold, the sending bank splits it into smaller child payments before it goes through. Each child payment gets a brand new UETR. The original UETR doesn't disappear. It just stays inside the splitting bank's own internal mapping, never published to the network. This behavior applies at any PMI hop across the whole guide, not only here in the customer payments, but usually customer payments with such high value are rare, and they are also intercepted inside the bank. The same splitting concept can be seen on the flow. When a single payment is sent, you saw the steps 3 and 4. Now, when the split happens, this is as good as a new payment being sent, and this split payment with new UTR flows like any other payment through PMI as shown in steps 3A and 4A. The final leg of this scenario between creditor agent and creditor will be same as we just discussed. Based on the settlement or who holds the account between creditor agent and creditor, either credit notification would be sent or the payment itself would be forwarded. Here is the insight worth remembering long after this video ends, and one of your main key takeaway for the entire series. One fact: who holds whose account and how of the payment currency quietly decides three separate things across this entire series. It decides the settlement method code INDA or INGA when direct relationship between banks, or CLRG when it is with clearing, or even when no account relationship, then COVE method, which we will see in a while. It decides whether a rejection uses a status message or a return, and it decides whether a final leg is a simple notification or a forwarded instruction. One relationship, three outcomes. Now, let's look at the two ways cover funds actually move. Cover and advise are ways to move funds. We shall discuss about them at field level details in the dedicated videos. For now, we shall look at them from flows perspective only. Cover and advise look like two different topics, but they are built from exactly the same shape. A direct notice plus a parallel funding leg running alongside it. The only real difference is who is paying. Cover is the customer flow method. Advice is the financial institution flow method. Let's start with cover. And we are back on the familiar customer cast: Northwind Traders, Meridian Bank, and Crestline Bank. Northwind sends pay no one to Meridian, step 1. Then Meridian does something new. It sends Paxo 8 straight to Crestline as the step 2, a single message that bypasses the entire correspondent chain. Why does Meridian do in this way? What are the conditions to be fulfilled before it can send in this way will all be discussed in another video. For now, just remember one thing. Any bank to exchange messages over the network need a permission which is called as RMA, Relationship Management Agreement. Without this agreement, no messages can be exchanged between two banks. This backside message is called direct message or an announcement message. It can also be called as advice message, but the term advice is reserved for the FI to FI flow. It lets Crestline know a payment is coming. So Crestline can credit the supplier immediately at its own risk or choose to wait. This direct message, though sent directly from Meridian to Crestline, it also contains the complete information about the way funds would arrive. Also mentions the Atlas and Harbor Banks information as reimbursement agents. Crestline acknowledges that it received this direct message information using a PAX2 message, just like we saw in the first two videos. In parallel, and this matters, Meridian sends the real funding leg as Paxo9 cow in step 4, moving through the correspondent chain to actually reimburse Crestline. The sender and receiver correspondence will be aligned accordingly in both the messages. In Paxo 8, they are called reimbursement agents as they reimburse the required funds. And in Paxo 9 cow, they become the debtor agent and creditor agent. The two steps of 2 and 4 fire close together. The direct messages optional acknowledgement is not a gate the funding leg has to wait for. They are running side by side, not one after the other. But in some banks, I have seen they wait for the PAX2 acknowledgement from correspondent, or in majority cases, they wait for the Swift Network Act before triggering the funding message of PAX9 cow. This nuance varies from bank to bank. Paxton cow is acknowledged by Atlas with Pax2 in step 5. Now this Paxton cow moves from Atlas to Harbor. This can happen directly between them or via clearing, just like we saw in the FI to FI transfers. Accordingly, these messages are acknowledged using Pax2. This next part trips people up. So let's slow down. Firstly, a question to you all. Why is it named Paxo 9 cow and why not Paxo 8 cow? As we have seen, the PAX message number 08 is for the customer payments and PAX message with number 09 is FI to FI transfers. The cover scope starts from a FI and ends at another FI. So it is basically a FI to FI flow covering a customer payment. That's why this message is Paxo9 tagged COV. This message has full information of the direct Paxo 8 embedded inside it. Next, in direct and cover flow, the cover overall scope is from where the direct Paxo 8 starts and where it ends. In this case, the cover flow starts from meridian, which is called debtor in cover flow, and ends at crest line, which is called creditor in cover flow. Now, inside this specific Paxo9 cow message, sender correspondent, the Atlas Bank, is playing the role of debtor agent. Receiver correspondent, our Harbor Bank, is playing the role the message itself calls creditor agent. And Crestline Bank, the canvas's real creditor agent, is playing the role the message calls creditor. Confusing? But it matters because the same accounting relationship fork from the FI to FI section applies here too between these two specific parties. So, based on the Nostra-Vostra relationship, either CAMT 54 credit notice, CAMT 5352 statements is triggered, or the payment itself, in this case, the Paxo9 cow, will be forwarded to the Crestline Bank accompanied by Pax2. Remember this. By the end of the cover flow, the funds will reach the Crestline. the original creditor agent or the original receiver of the Pax 8 direct message. Now, separate that from the full chain's actual ending. Once the covering funds reach Crestline Bank, Crestline notifies the real creditor, Ridgeline suppliers, with a simple CAMT notification or any other retail means of SMS, email, or push notification. No forwarded message alternative here. Ridgeline is a customer, not a bank, and a customer isn't built to process a PAX9. Last step for cover. Once everything's settled, Crestline matches the incoming PAX9 cow or the CAMT message against the earlier direct Paxo 8 using the UETR or the end-to-end reference. That closes out any risk Crestline took on if it credited Ridgeline early before citing the funds in the cover flow. Some banks, based on their risk appetite and relationship with their customers, credit the funds just on receiving the Paxite direct message. Multiple non-STP scenarios are possible here if the amount do not match, value date do not match, etc. And each bank has its own way of handling these scenarios. Now, advice. The FI flow version of the same cover pattern. Here, the debtor itself an FI and initiates directly with a plain Paxo 9. Note, it is not Payno 1. This is payment initiation step 1. Debtor agent then sends Pax 9 tagged ADV straight to creditor agent in step 2, pre-advising it of the incoming payment. This is the same as the Pax 8 direct message. That's genuinely useful for liquidity and position planning across time zones for the FIs. This is acknowledged by a PAX2 in step 3. And just like cover, the funding leg runs in parallel. A plain PAXO 9, no ADV tag this time, since there's no underlying customer PAXO 8 to reconcile against. It travels from debtor agent through intermediary 1 to intermediary 2, either directly or through a PMI with the PAX2 acknowledgements, exactly the same either or pattern you already saw in earlier flows in steps 4, 5, 6, and 7. Here's that same tricky role mapping again, this time for advice. Inside this funding message, intermediary 2 plays the message's own creditor agent role, and creditor agent on the canvas plays the message's own creditor role. Same structure as cover's own final leg. If you followed that one, you already understand this one too. And based on the same pattern, either CAMT message or the funding message itself is forwarded to the creditor agent in steps 8 or 8A and 8B. But here's where advice genuinely diverges from cover. Creditor agent notifies the real creditor, and this time that real creditor is itself an FI. So the branching logic from earlier in this video, notify with CAMT message or forward the payment itself, can genuinely apply again at this final step. For cover, that branch never applies at the end. For advice, it can. Let's put cover and advice side by side. Cover is initiated by a customer with Payno 1. Its direct message is Paxo 8 and its funding leg is Paxo 9 cow. Advice is initiated by the FI itself with Paxo 9. Its direct message is Pax 9 advice and its funding leg is a plain Paxo 9. One method lets creditor agent credit sooner at its own risk. The other pre-advises for liquidity and position management. One thing to note is that in cover flow, the funding leg message of Paxo 9 cow message carries the entire underlying Pax 8 direct message along with it. Whereas in advice flow, the funding leg message of Pax 9 does not have such option to carry any message. The flow might seem similar, and it is similar, but the main difference is the messages that these flows happen, and the structure of these messages is the fundamental difference between the cover and advice flow. We shall see all these differences in detail in separate video. One small thing before we move on, and it's worth getting exactly right. Every cover or advice flow actually has two distinct final legs: the funding message's own endpoint, where the correspondent or intermediary hands off using the message's own internal role names, and the full chain's true endpoint, where the creditor agent finally reaches the real creditor. The accounting relationship rule governs that first endpoint every time in both cover and advice, because this flow is in between the banks. But it only governs the second endpoint when the final creditor is itself an FI. That's true for advice. It's never true for cover. Let's name the mistakes people actually make reading these flows. Trap 1: mixing up PAX 8 and PAX 9. PAX 8 always means the debtor is a customer. PAX 9 always means the debtor is a bank. Get that backwards, and the rest of the flow stops making sense. Trap 2: reading the final leg branches as if both happen. Notify or forward is always an either or choice, decided by who holds whose account, never a sequence where both fire on the same payment. Trap 3: assuming the GPA tracker applies here by default. It doesn't. FI to FI payments run on GFIT, a separate optional service. It is not mandated like the customer tracker. GCCT and GCOW are for customer flows and mandatory services. Trap 4: assuming the PMI always confirms the settlement itself. Most of the time, it's a transparent pass through, and the two correspondent banks acknowledge each other directly. The PMI only issues its own confirmation when it's actually acting as the clearing rail between them. Trap 5: treating the two final legs as one and the same thing. The funding message's own endpoint and the full chain's true endpoint are two separate handoffs. Confuse them, and the accounting relationship rule stops applying correctly to either one. So, here is what this whole video really comes down to. It was never really about the message type. FI to FI payments strip away the customer layer and the mandatory tracker. And in doing that, they expose something that was quietly running underneath every flow in this entire series. It is the accounting relationship between two banks, not the message type, that actually decides how a payment settles. Next up, video 4, we will cover direct debit, pulling money instead of pushing it, plus the reference and administrative messages that sit around the edges of every flow you have seen so far. If this series is helping you actually read real payment flows, subscribe and find the rest at paymenttalks.com. Until then, keep smiling and keep learning. Thanks for watching this video. If you like this video, please like, subscribe and share for more such interesting topics on payments.